Welcome to another episode of Einstein Retirement Daily, where we curate financial, economic, and market news for the headlines that could affect today's retirees. Today we're going to discuss the Federal Reserve. They've had some meetings with Congress, and Jerome Powell has had meetings with Congress, and we're going to talk about what's been said and why certain things are not being said. All this coming right up. As always, if you hear something in today's podcast that causes you to want to make some changes, take some action in your personal situation, please be advised that this podcast is not to be considered as specific tax, legal, or investment advice. If you hear something today that causes you to want to take some action, please confer with the appropriate tax, legal, or investment professional who knows your specific situation prior to making any changes. As I'm sure many of you know, or if you don't know, Jerome Powell is the Fed chairman. Jerome Powell met with Congress recently and had to provide some reports to them about what his policies are going to be, the Federal Reserve's policies more specifically, are going to be with a few factors in mind. Number one, jobless claims are going down. Number two, inflation is on the rise. The primary objectives of the Federal Reserve System is to manage inflation and employment. If you read anything about modern monetary theory, which I would encourage you to do because it will do the best job of explaining the system we have today. Now, I'm fairly critical of the system that we have today, and so the ascriptions, I guess you could say, that I would maintain are going to fall in line with, say, the Chicago School or the Mises Institute for Economic Theory. But so my sort of allegiances economically sort of fall more in that realm of things. However, if you want to understand what we're seeing, you don't want to go to the opponents, you want to go to the source. And the source for what's going on right now in our economic and systems and institutions that control our economy here in the States, you want to understand modern monetary theory. Modern monetary theory, again, is going to ascribe that it is the role of the government to manage employment and inflation. Now, right now, the Federal Reserve is the entity that is tasked with doing that. The Federal Reserve System is going to manage inflation generally by raising interest rates. Why is it that inflation gets managed by raising interest rates? Well, inflation is the increase in the money supply. If you lower interest rates, hypothetically by stop buying treasury bonds, you inject less liquidity into the system, interest rates rise, and it makes money lending less easy, and that's the primary way that we inflate the currency in our system. So the Federal Reserve is very afraid of raising interest rates. Now, they say that it's because we haven't hit full employment, that inflation is transitory. However, I believe that the Federal Reserve is also afraid of crashing the stock market. Now, they've never admitted to this publicly. I've never seen an interview where the Federal Reserve System has said anything really about its role in the growth of the stock market itself. But the reality is that much of what the growth in the stock market has become of late is due to what we're seeing in terms of Federal Reserve policy. Two primary reasons why. Number one, the Federal Reserve System in buying U.S. Treasury bonds through simple supply and demand being very high, supply being also high, so the dollars are going up, it pushes those interest rates down. So as demand is very high, the price of the bonds goes up, so the interest rate goes down. There's an inverse relationship between price and yields. So if there's a lot of demand for treasury bonds because the Federal Reserve is buying billions of dollars of them, the demand is high, the price goes up on treasury bonds, the yield or the return goes down. Treasury bonds are a benchmark for other interest-bearing securities like individual bonds, corporate bonds, municipal bonds, that sort of thing. If bonds become too high in terms of their interest rate, so the interest rates on bonds goes up to a level, let's say that a 10-year investment grade corporate bond pays 5%. How many retirees are there out there right now investing in stocks begrudgingly? I mean, I don't know the answer, but I talk to a lot of people who invest way more in stocks than they're actually comfortable investing. And the reason for that is because there's no yield in bonds. I mean, what am I going to do? Get 2% on my fixed income? I can't live on that. And so they are begrudgingly investing in stocks. Very common problem that we have right now. But at 5%, if I could buy a 10-year corporate bond, an investment grade giving me 5%, now that looks like a great deal. And so as an investor, I'm going to be very tempted to go and switch over, sell my stocks and buy these investment grade bonds paying higher yields. So that would be great for the average retiree, and certainly we would like to see something like that from that perspective. But the problem is then we have cash flow that is still invested but used to be in stocks that's now leaving stocks. Okay, so less dollars competing for stocks. Simple supply and demand tells us that the price on stocks in total will go down. So if we have our investors, our regular investors, people begrudgingly invested in the stock market who start shifting dollars over into fixed income, that will hurt stock prices. In addition, the big players, where the big problem is going to happen, are your pension funds, endowment funds, investments that historically have been relegated to using primarily low-risk investments. Many of these pension funds, endowment funds, these sorts of things, have loosened restrictions so that they can buy more stocks than really they want to. So they don't want to be invested in stocks like they are. But again, there's no yield in fixed income or bonds. So they get the restrictions lifted so they invest in stocks. But there again, if those 2% bonds are now paying 5%, will pension funds shift assets, endowment funds shift assets out of stocks and into these fixed income positions? Yeah, you better believe it. And so the Federal Reserve, although they don't admit it, I assume they understand that a rising interest rate environment spells big time trouble for the stock market, if only from a supply and demand perspective. Not to mention that a rising interest rate environment allows JP Morgan, Wells Fargo, Bank of America, these big banks to increase their corporate lending rates. And now Apple can't borrow money at 2%, they got to borrow at 3 or 4%, or maybe even 5%. Now we're talking about major shifts in how much these companies are engaging in things like stock buybacks, borrowing money to get additional capital into their corporations, thereby increasing dividends and things like that. And so the Federal Reserve, I would say, is very afraid of crashing the stock market. I never really anticipate them admitting to this in public, but it's a big-time problem. Wall Street Journal had an article today from Nick Timiras. I don't know how to say your name, or Nick. I'm so horrible with names. I don't know why. I really value names a lot, actually. Believe it or not, but without asking someone, I would ask Nick if I met him. I'd say, "Hey, Nick, pronounce your last name for me, please." But Nick's not here to ask him. So, article from the Wall Street Journal discusses how Jerome Powell is saying things like, "Well, we're very concerned about inflation. We understand that that's a big concern. We think it's transitory. We see a lot of more inflation in areas of the market like used car prices, so we think this is a more transitory issue than people are maybe giving credit for." And so these are certainly valid things to be said, but we do see consumer price indexes much higher than we would have anticipated. Single biggest increase occurred in over 10 years just last month. So a lot of things to be concerned about. The Federal Reserve is committed, as the article reminds us, to a 2% average increase in inflation. If you look back over the last several years, we've not seen 2%. It's been lower than that. So in some ways, the Federal Reserve is comfortable having 1 year that's higher, but I think we're going to see a big reaction going into next year if the Federal Reserve continues to see higher inflation rates, and certainly we would want to be mindful and prepared for that. Okay, that's all for today's podcast. I'll link the Wall Street Journal article, and if you have not yet seen one of our live workshops, we would love to have you attend. Simply send us a message through Facebook and visit our Facebook page, Einstein Social Security or Einstein Retirement Workshops. Send us a message and we'd be happy to get you registered for one of our upcoming workshops. With that, we'll wrap up today's visit, and not really a visit, although we visited together. It was enjoyable. Glad you're here, and we'll wrap up for today. Look forward to seeing you next time. Subscribe to our YouTube channel. Leave us a comment. Share this if you like it, and we'll talk to you soon.